Yes, I'm responsible. How can I prove that? My dog hasn't run away yet. Welcome back to the Red Desk, the place where some of the biggest financial decisions of your life are discussed over this fabulous shade of red. Today's topic, FHA and conventional loans. Loans, those amazing but also terrifying financial instruments that can give you the life and home you want. Serious long-term decisions, like longer than the gym membership you never use. Yeah. Housing loans stick with you for decades, so please take your time. What you decide now will cost or save you a lot of money, so it literally pays to pay attention. Today, we're going to show you exactly how to choose between the two major loan types, conventional and FHA loans. There are pros and cons to both, and what is best for you will depend on, well, your personal situation. Loans are like different types of apples. They look and act pretty much the same, but some are better for baking than others. You know what I mean. Conventional loans are the most common loan type and are given out by private lenders or banks. You need a decent credit score, a good debt-to-income ratio, which is just how much your monthly income goes towards debt, and usually a 3% or higher down payment to get one. FHA loans are backed by the government. The requirements are less restrictive, so if your credit score is low or if you can't afford a large down payment, then FHA loans make sense for you. We'll dig into these differences in more detail in just a sec, but here's a quick side-by-side comparison. Okay, let's look at why these differences matter. The most immediate difference between the two is that it's easier to get an FHA loan. If your DTI is higher than 45%, then you'll have to get an FHA loan or wait until you can improve your debt-to-income ratio. Same thing for your credit score. If you're below 620, then you have to get an FHA. And if you just squeaked by 620, it may still make sense to get an FHA loan. Because FHA loans are for people who have hit some financial potholes, you can't borrow as much. Another difference is how the loan types handle mortgage insurance, which is the fee that protects the lender if you don't make your payments. FHA loans use something called a mortgage insurance premium. This fee is paid upfront and monthly. The upfront fee is usually 1.75% of your loan amount. So if you borrow $150,000, you'll have to pay an additional $2,625 on top of that down payment. But afterward, the monthly premiums tend to be cheaper than conventional loans. Conventional loans require PMI, private mortgage insurance, unless you pay more than 20% down. But there's no upfront insurance premium like the FHA. Here's the deal. Most people go with conventional loans. It's named conventional for a reason, but each situation is unique. Here are some general guidelines. You should probably get a conventional loan if your credit score is at least 620, you have a down payment of at least 3%, or if you want to avoid PMI by paying 20% or more, you have a low DTI, or you want flexible repayment terms. And you should look into an FHA loan if your credit score is below 620, you can only make a small down payment, or you have a high debt-to-income ratio. The right loan choice depends on a lot of factors. But remember, your ultimate goal is to own a home with the lowest interest rate, while also not leaving yourself financially vulnerable by draining all of your savings. If you keep that in mind, then you'll make a good choice. Finding good lenders you can trust to point you in the right direction based on your unique financial needs is huge too. Speaking of which, that's exactly what my amazing colleagues at Rocket Mortgage do. They are incredible with loans and making sure you choose the perfect type for your home and future. If you want to see which option could be right for you, head to the link in the description. Okay, now go and make a good decision. Thanks for checking us out. If you would like to see more videos, you can always click right here, and don't forget to like and subscribe. We'll see you next time.